Everyone. I have not got a TikTok dance lined up. Thank goodness for you, me and everyone else, I think. Look, it's fantastic to be with you to provide a little bit of a probably higher level than what you've heard from the Minister and the FMA around what we're thinking about for this year. And I think probably the most important as an economist is sometimes I worry when I go through over the summer period that I go and get some sunstroke and worry too much about the economy. This year I've come back with a little bit more optimism than before, which is certainly encouraging. We see the economy shifting gears this year, which will be welcome relief, I think, to everyone out there after a fairly tumultuous couple of years. We're still, I guess, questioning where we go over the more medium term, but certainly some of the numbers that have been coming through recently have confirmed that expectation of the greener shoots starting to show through. We were all been talking about survive till 25. That was never survived till the 1st of January 2025, but it has now started to come through that we are better and continuing to see better results. So that shifting gears will allow us now to see some of those better economic trends. Just briefly, I want to go through, and because I'm an economist, sort of just speaking off notes gets quite boring, so I've made a bunch of charts and tried to do some homework, so hopefully there'll be some pretty pictures that I'll put up in a moment. The most, I think, important thing is that there is still quite a lot of difficult balancing, because for the economy we've gone through such big ups and downs the last couple of years that we're now trying to figure out where the Goldilocks zone is. What is new normal? And it's probably nowhere near as close to pre-pandemic levels as people might have expected. On the first point, we are seeing better economic trends when it comes to inflation, and that's certainly encouraging after some pretty challenging couple of years. As a Zoomer, a Gen Zer, I hadn't seen inflation as bad as it got last time. I wasn't born in the 90s when inflation last sort of peaked, so this has been a new experience for me, but probably a few of you in the room have seen that before and have known how difficult it is. We've now gotten a fair way through that. You can see on the chart, though, a few different drivers of that again start to raise not necessarily worries, but just a few cautions as we head into the year. The likes of inflation coming back down to its sort of target zone between 1% and 3%, having been driven so far by the tradables, the imported inflation being a lot less intense. Great news, not a lot we did about it here in New Zealand, which also risks that as you start to see some of those global shifts, and geez, there's been a couple of those in the last 24 hours as well, it means that we are more exposed, we're looking a lot more at the world. And I guess that's sort of a conversation we're having a bit more this year, is that previously for New Zealand we've been looking a lot at how the likes of the domestic environment has been a lot more challenging. We haven't been as much in control of our own destiny as we've tried to get the sort of economic balances right. This year we start to shift the dial. We see a lot more of that domestic activity coming through, but the global activity, the sort of trading environment becomes a lot more challenging. The other challenge I think with inflation is that, sure, great to see it back at 2.2, it's been there now for 2 quarters, definitely a more positive result. But that's 2.2 on top of, 7% the year before that, and 7% the year before that, and 4.5% before that. The cumulative increase in inflation means that the operating environment, the cost pressures on businesses and on households still remains quite intense. And by that I mean, you go back 5 years and you spent more and you got more. That was sort of pretty easy to communicate, be it to your own clients, to your customers, to your stakeholders. Now you spend more and you hope that you get just the same as before, but probably you spend more and get less. That's a very different ball game that I think we're still trying to adjust to, and one of the things we're finding in our conversation with businesses is that difficulty of trying to sort of right-size the budget, right-size what's happening with those levels of spending, enough to keep the business moving and to keep yourself in a profitable situation, but also not so much that you have to lose business to try and keep some of the money you've got coming in. So that balancing act again remains a key one. We know that not all businesses have been able to achieve that. Over the last year we saw a 37% increase in liquidations across the country, 2,500 businesses lost. To be fair, we had more than 2,500 businesses that also sprung up over the last year. So this is just those who have definitely found it tough and haven't been able to continue operating. But it does highlight again those pressures that we're still seeing. I think all of this is important to keep in context. You can see those liquidation numbers have lifted up from a low level, still quite a bit below the likes of the global financial crisis, even though we've got a heck of a lot more businesses these days. And that is, I think, again, part of the message we're trying to highlight. Yes, it is difficult out there, it's certainly been difficult, and there's greener shoots coming through, but we've got a much more mature way of trying to deal with the economy than the last time we had an economic shock like this, which was sort of around the GFC. So it's a very different operating environment. What's also different from the last couple of years is that the government is playing a less active role in the economy and a much more indirect role. And over time, that's sort of probably necessary, given, to be short, the government hasn't got a lot of money left over. And after the last couple of years, you can see on the chart here some pretty big levels of spending growth coming through from government on the consumption and investment side. In fact, over the last year, Stats estimates that there was a whole lot more than we first expected. But into the next year or so, we think that there is less spending by government. There's a little bit less investment as the government tries to get fast track and similar underway, but also from a consumption side, those cutbacks in government activity will start to hit. And I think that does change the game a bit, because for quite a while, and this is where I think some of the conversations from government around growth have come from, business didn't need to do quite as much the last couple of years. Government was holding this sort of heavy economic stick. It was doing a lot of that work itself. It wasn't saying, business, we're going to create the right conditions for you to operate. It was going, here's some money, we're going to spend it either with you or on you or somehow, and we'll just do it ourselves. That meant that the size of the state got effectively too big to handle long term and has now become a bit unsustainable and certainly a bit unwieldy. That's important though for businesses, because the message that's coming through a lot from government around growth, and you heard it a lot in the Prime Minister's speech and media commentary subsequently, around effectively trying to say yes rather than saying no. The underlying tone there is, in my mind, that previously, if you're a business, there was more of a risk of saying yes to stuff and trying something different than the risk of just standing still. It was actually pretty comfortable to sort of do not a lot. Yep, there were incremental moves, but there wasn't a lot of need to sort of push forward because there were other factors in play. Now the risk is starting to become, if I don't move, someone's going to move ahead of me and I'm going to be left behind. And I think that's a healthy level of pressure, healthy level of business fear that we should have to try and move us along, because our productivity does suck. And I think, importantly, the government is not the right one to try and drive that. And so it is encouraging this conversation that we've heard this morning and similar about how does government set the right guardrails so that we don't completely go off the end of the roller coaster, but also enough that the roller coaster is fun enough that you get up some speed and don't just have a lame ride. That is the balance that I think we're trying to find here. And we are starting to see as well in the short term some of those better trends. And I think that's an important move here. For that long-term productivity to come through, it's sort of like with your KiwiSaver savings, you want them to be there in retirement, but you also need to make it to retirement to use them. And so in the short term, there's then that question of how do we get that growth and economic momentum going. We're starting to see those early signs. The likes of job ad numbers out in the economy have started to lift ever so slightly. They've bottomed out and have started to trend ever so slightly upwards. Still at a low level, but again reassuring that for businesses, confidence breeds confidence and activity breeds more activity. And so the fact that you've started to see those job ad numbers start to level out does suggest a bit of a shift in momentum. Businesses are not going out and hiring huge hordes of people every second of every day, but they've stopped cutting the number of job ads they've been putting out, and it's starting to sort of stabilise. That is that sort of first turning point that's emerged. The same when it comes to job numbers. We've seen a 0.3% increase between October and December. It's 2 months. Let's not get ahead of ourselves and say that the economic recovery is definitely here, but it's on its way because we are again seeing that turning point. The same across construction and a number of other economic indicators. Now, I haven't shown you, and I won't be showing you, to be frank, in this presentation, a GDP track. One, because, let's be real, it's a tricky one to sort of describe, but two, we've been through such an intense, severe recession last year that the numbers sort of are, again, a bit more all over the place with revisions. One of the better economic indicators, though, and one that's a lot more relatable to you, but to everyone you work with as well, is spending. If I've got money in my wallet and I'm willing to take it out and spend it, then obviously things are going all right. If I'm not spending it, either it's not in my wallet, which is a bad sign, or it is in my wallet and I'm worried about the future, which is an equally different but bad sign. Since July, we've seen a 3.8% increase in card spending across the economy. Now, you'll see on this chart that we're sort of just filling in the hole that was there over the last year and a half, so we're not rolling in cash, but again, that shift starting to come through. And this is where we think most of the growth will emerge for New Zealand over the next year to year and a half. It will be very much driven by households. Interest rates are coming down, that's encouraging a lot more activity, and we're starting to see some of that spending. Given interest rates have now been falling since about August, September, Infometrics calculates that already we're seeing about $8 million a week more in available money coming through that isn't now being spent on mortgage and is available to be spent in the economy. By the end of this year, we expect that to increase to about $45 million a week. That's equivalent to sort of 1% of private consumption all at once. Now again, we're not expecting the economy to absolutely rocket ship to the moon. We're trying to get it back to a more stable, solid level of growth. Over the last sort of 2 years, we've had quarterly GDP that's averaged about nothing, 0.0%. And of course, through most of last year, we lost a whole 2% in 6 months. Going forward, we expect 0.5%. It's not humming, but it's just starting to get that economic motor rolling a bit more into the future. And so again, that feeling of encouragement. Part of this is because, as I said before, confidence breeds confidence, and households are ready for it. We've seen in the last couple of months of last year a much heavier focus on people that, funnily enough, knew that interest rates were coming down, decided to fix short or to float, and got ready to bring that money in. That's different from the likes of the global financial crisis. No one knew that that one was coming, so everyone was locked in for a bit longer. It took us a good 12 to 18 months to rev the economy back up. At the moment, we know that there's a fair amount of the mortgage book that has to refix over the next 6 months or so. People have already been doing so, and all of a sudden you're going to see that greater level of money come through. What it also does highlight, though, is that people do, and there is, I guess, that inherent risk here that people start to overdo those expectations. At one point, you had nearly 50% of new mortgage lending going on floating rates, and there seems to be a real view that everyone's now become a TikTok sensation around interest rate expectations and what their bank should do next. And I guess the only point here, and that you've seen a little bit of talk of, certainly over the last year or so, is the importance of having that good, solid financial I guess, capability, that financial education that sometimes I do feel like is lacking for New Zealanders. So encouraging that those interest rates are coming back, but maybe a bit of caution too. Before anyone asks, I do have an interest rate prediction for you. We expect the Reserve Bank to cut the official cash rate by 50 basis points in February. That's almost locked in. I think if the Reserve Bank doesn't do it, then they sort of have to walk back some pretty strong words back in November. The question, however, is how many after that. And at Infometrics, we think we're a little bit closer to the bottom of the interest rate cycle than I think a lot of people expect. In fact, we think there might be maybe one, maybe two further cuts after that, but even those aren't assured. We've seen in the US that the Federal Reserve has decided to press pause. There's been a lot of pullbacks in just how many further interest rate cuts there are, and which again leaves that point of, yep, there's some unlocking and spending coming forward, but we're not necessarily going to go quite as far as really revving things up. For rural New Zealand and regional parts of the country, there are better signs to come as well, and we think more economic activity will start to show through quicker in provincial and regional New Zealand than in the urban centres, and that's particularly because of the commodity prices that we're seeing. The chart that you can see on the screens behind me shows inflation-adjusted commodity prices, because everything costs a whole lot more, but you're also making a lot more money, and so if I showed you just the unadjusted figures, you'd think that we're actually absolutely literally creaming it. Not quite so much, but you can see again that those increases have been coming through. We're still seeing solid levels of demand and higher prices for dairy. We're seeing improved numbers on the likes of the meat front, and the same with the likes of horticulture as well. That gives us a bit of confidence in the short term about some of our export opportunities. But as we've seen over the last couple of days, the global picture is now becoming a lot more difficult to manoeuvre. We have another at least 4 years of unpredictability, and I think one of the challenges that we face going forward is that all of that is quite difficult for a small trading nation like New Zealand. It increasingly shows that yes, we've got to have some diversification in our trading partners, but equally that as bad as we think we might have it with concentrations around China and the US, at least we're not Mexico and Canada, who have like most of their trade going to one country who then decides to levy tariffs. Like, we're not quite that exposed. Into the future, what does that mean? We think that there are those bigger export opportunities coming through. You can see that our export forecasts aren't particularly upbeat. They're solid, but again, we think that's where more of the medium-term growth can come from. If we can lift those export potential numbers coming through, if we can get those bigger opportunities, that will be important. That does raise a big question for New Zealand. We know that our biggest trading partner in China has not been performing quite as well. Our new second largest trading partner in the US, well, they've decided to enact trade wars like we haven't seen for nearly a century. So where do we go? We've seen more agreements being signed by governments of all colours over the last sort of decade or so, and that's an increasingly large net, and we've got to continue to do those. But I think a real area going forward is just using those trade agreements that we've got to their fullest potential. We don't necessarily always need to chase the next shiny thing. Just using what we've got will be important. You can also see, though, that we expect that imports to be a little bit more languishing until we sort of hit 2026-27. And in a sense, although it might seem counterintuitive, we'd like to see a little bit more of that import growth, because it would suggest that actually New Zealand businesses are buying a bit more tech, a bit more innovation, a bit more productivity growth that comes through as they start to capitalise and bring forward a bit more investment. That's an area I think that is still ripe for the making, and that we think there are bigger and longer term potentials through. So, long story short, we're seeing better economic trends. We're certainly starting to feel a lot more upbeat about economic conditions in the country, and as an economist that feels very weird to say. We're normally the doomsayers, the people that get up and tell you that everything sucks and that nothing's going to get better anytime soon, and that if it is, here's a few more issues to weigh on your mind. I've done some of the latter part of that this morning, but we are more confident in the short term. We're trying to figure out where the new Goldilocks zone is. We start to think that just getting back to solid is an important starting point, and then looking forward is how do we solve those bigger productivity issues. That is going to come a lot more on the private sector than just coming from government, and so I guess the challenge here is that as good as it is to turn up to breakfast and similar, I do enjoy these sort of conversations. I hope that you all go back as well and think, how do I do this a bit better myself instead of relying on others to? What's my sort of line in the sand that I can make a move on, not just so that I have better economic results this year, but also going into the future.
Obviously a few questions about Trump and tariffs and where that goes, and I know that's pretty hard to quantify really for anybody, but just framing it around interest rates, which are so crucial for New Zealand, and you're looking at what's happening in the US, what's happening with wholesale bond markets and the interest rates there pushing up, the yields there pushing up. How do you see that playing for the Reserve Bank when they look at the OCR, the margins between those wholesale bond rates and the OCR?
I think the big one for us at the moment is it probably plays into that risk that I've just profiled around we might be closer to the bottom. It doesn't change the immediate expectation around the likes of this 50 basis point cut in February, only because the Reserve Bank made a pretty strong rod for its own back there. But I think you will see a bit more of a conversation coming through around the risk of that tradables inflation, that imported inflation. And I think that's because this is not necessarily a brand new risk, but it is certainly sort of a shift in the risk tone. Start of this year, out of the US, we saw data showing that long-term inflation expectations were their highest in the US since the likes of 2009. So you already had this sort of worry amongst businesses and households that long-term inflation was going to be a bit higher. You add tariffs on top of that, and I think that just sort of adds to the case. So now the balance of risks, I think, is more that things might be cut short, the cuts might be cut short sooner rather than later, and that then if you look at what the Reserve Bank was saying even in the last week about productive capacity, we're now closer, we have a much more narrower sort of operating environment where we try and get a bit more growth, we push a little bit too close to productive capacity, inflation goes up and the Reserve Bank can't actually allow interest rates to sort of be as low. So long story short, I feel like it does mean that we've sort of got a more constrained growth profile going forward, and that means as well that we are way more inextricably linked with the rest of the world than we have been before. There's been trade disruptions and similar, but now we're looking at going, well, if we import more inflation, then that's going to hit us a lot more directly.
Sure. I guess, yeah, I mean, how worried are you about the trade war escalating, and how much do you take everything at face value there?
Does anyone take anything at face value with the President? I guess it's been interesting how bold the Canadian move has been in terms of response. I mean, you know, whereas, you know, we saw overnight that Mexico decided to sort of try and play ball and figure out how to lessen that blow, and in this case get a bit of a reprieve for a moment. Canada's sort of gone, look, we're going to hit you back where it hurts because we know that we're going to get hit, but also encouraging people, you know, to buy local. There's big big Buy Canada campaigns, and I've seen lists already of people saying, here's an American product that you normally buy in the shops, here's how to buy the Canadian equivalent. I guess the worry is that you've got Canada that's sort of gone quite gung-ho, you've got Mexico that's tried to find sort of a more pragmatic solution. We've heard nothing out of China yet, but then if you get the likes of the EU and everyone else in the mix, it does start to worry you that yes, a bigger trade war comes through. And I guess there's been a lot of questions that I've fielded the last couple of days from people going, what does this mean for New Zealand? And I've sort of said, well, don't check your KiwiSaver balances because it probably doesn't make it look great. But more importantly, look, we're not going to pay anything more for goods right this second, right, unless we have tariffs. But it's more that if we're seeing lower trend growth in our trading partners, then this idea that the government wants to double trade, over a decade and similar becomes a whole lot harder. So it's more that wider operating environment that, we just need a sliver of growth, but if the sliver of growth that we're getting comes from a much smaller pot, then that hurts us too. That's the worry.
Sure. Look, we are out of time. I've got one more question. It's the classic Kiwi question for every economist. New Zealand property market in 2025. Have you got a lightning take?
Yeah, look, we think it'll go up, but I don't think it'll be massive. I mean, it's more that it's gone down for a couple of years and there's probably a little bit of recovery coming through. So yes, a little bit more growth, but I think for the first time in my entire professional career, which to be fair isn't that long, so take that with a grain of salt, is that I don't think there's all that many people out there that come up and whisper in my ear and go, geez, property is just absolutely, one, roaring, and two, going to roar again and just continue to go up. I think there is a bit of a shift now where people go, I've got to be a lot more temperamental. I don't know if it'll grow massively. I don't know if it's the best option for my money into the future. And so I do think there's a longer term shift. The big one for me will be when Treasury changes its forecast to actually build in the government's expectations of making land and that more available, because at some point you are going to see house prices in our minds that basically just move sideways for about 5 years. So yep, a bit of growth mathematically so, but I certainly wouldn't be betting my non-existent house on it.
Thank you very much, Brad. Cheers.